As of the market close on Friday, November 28, 2025, Supermicro Computer Inc., trading under the ticker SMCI on the Nasdaq, ended the session at exactly $33.85 per share. The stock demonstrated a notable intraday recovery, pushing up by $1.02 to register a gain of 3.11% for the day. While the market is currently closed for the weekend, the after-hours tape shows continued interest, with the price ticking slightly higher to $34.09. Throughout the Friday session, we saw the stock open at $33.33, dip to a low of $32.88, and hit a high of $33.86 right before the closing bell, with a trading volume of roughly 10.7 million shares. This volume is significant, though it trails the manic turnover we witnessed earlier this year. When you look at that $33.85 price tag, the expectation from the broader retail crowd, perhaps the same people chatting in Discord groups or checking their Robinhood app, is that Supermicro is a broken asset, a company permanently scarred by the auditor drama and filing delays that have plagued it for the last 12 months. The common belief is that this is a value trap, a stock that looks cheap compared to its history, but is destined to drift lower due to governance concerns. However, the reality of the situation forces us to look at a completely different metric: the physical deployment of liquid-cooled racks for NVIDIA's Blackwell architecture. While the market is obsessing over the legacy of the 10K delays from late 2024 and the Q2 hiccups in February 2025, the reality is that Supermicro has quietly cemented itself as the primary plumbing for the AI data center build-out that is currently accelerating, not slowing down. The disparity between the accounting risk narrative and the infrastructure monopoly reality is the widest it has ever been, and that is where the tension in this trade currently sits. To understand why this price level of $33.85 is so contentious, we have to look at the immediate market context. Just a few weeks ago, in early November 2025, we saw a sector-wide correction where NVIDIA stock took a sharp hit, dragging down the entire semiconductor cohort. Supermicro, often trading in sympathy with NVIDIA, was punished severely, dropping from the mid-40s to test support near $30. What we are seeing now with this 3.11% move on Friday is a technical stabilization. The sellers who were terrified by the sector cooling narrative have largely exited. If you use Interactive Brokers trading platforms, you might have noticed that the short borrow fee rates have begun to normalize, suggesting that the aggressive short-selling pressure is exhausting itself. The stock is no longer in free fall. It is in a period of accumulation where institutional hands are quietly picking up shares from retail capitulation. The narrative driving this recent action is heavily tied to the compliance story. We cannot ignore the elephant in the room. Back in late 2024, the resignation of Ernst & Young and the subsequent hiring of BDO USA was the peak of the fear cycle. Investors were convinced delisting was imminent. Fast forward to today, November 29, 2025, and the company is still listed, still trading, and slowly working through its backlog of filings. The market hates uncertainty, and the delayed Q2 2025 report in February 2025 brought that trauma back to the surface. However, the market has a short memory. The fact that BDO has remained on board and the company is executing on its Nasdaq compliance plan is a subtle signal that the worst-case scenario, fraud, is becoming less probable in the eyes of the smart money. The fear premium is evaporating, even if the price hasn't fully reflected it yet. Let's challenge the common ground here. Most investors using Fidelity investments or reading headlines believe that Supermicro's competitive advantage is low. They think that Dell and HPE Enterprise can simply step in, undercut SMCI on price, and steal the market share for AI servers. That is the consensus view. SMCI has no moat. The contrary take, and the one that is likely keeping the stock above $30, is that Dell and HPE are essentially assemblers, while Supermicro is an engineering-first manufacturer with a specific monopoly on building block architecture. This isn't just a fancy term, it means SMCI can redesign a motherboard and chassis to fit a new NVIDIA chip in weeks, whereas competitors take months. In the AI race, where a 3-month delay means missing an entire training cycle, that speed is the only metric that matters to customers like Meta or xAI. The market thinks this is a commodity hardware play. The reality is that it's a time-to-market arbitrage play. Analyzing the recent price action further, the $32.88 low on Friday is a critical level. Technically, this area represents a double bottom on the hourly charts, a classic reversal pattern that often signals the end of a downtrend. If you are managing your own self-investing strategy, you look for these capitulation points. The volume on the dip was lower than the volume on the recovery into the close, which is a bullish divergence. It indicates that when the price dropped, sellers weren't aggressive, but as soon as it ticked up, buyers stepped in with conviction. This behavior is typical when a stock is moving from weak hands to strong hands. The institutional data from Fidelity Wealth Management flows suggests that while retail sentiment is rock bottom, accumulation by mid-sized growth funds has actually ticked up in November 2025. We also need to address the macroeconomic pressures. The broader tech sector is dealing with high interest rates, which usually hurts hardware companies with inventory costs. However, Supermicro's specific niche, liquid cooling, is acting as a counter-cyclical buffer. As energy costs rise, data centers must switch to liquid cooling to save on electricity. Air cooling is simply too expensive for the new GB200 racks. This means SMCI's product becomes more valuable as electricity prices go up. This macro tailwind is completely ignored by the accounting scandal bears. While traders on SoFi stocks platforms are worried about interest rate hikes, the procurement managers at Tier 1 data centers are worried about their electricity bills, and that leads them directly to Supermicro's door. Moving into the fundamentals, let's look at what the company actually does for those who might be new to this ticker. Supermicro Computer Inc. manufactures high-performance server and storage solutions. Unlike a standard computer maker that sells pre-boxed units, SMCI uses a modular approach. They have thousands of SKUs, motherboards, chassis, power supplies that can be mixed and matched. This allows them to build custom servers for AI, 5G, and edge computing faster than anyone else. But the crown jewel is their direct liquid cooling technology. With the heat output of modern GPUs reaching levels that can literally melt standard components, liquid cooling is no longer a luxury, it is a necessity. SMCI produces the cold plates, the manifolds, and the cooling distribution units, or CDUs, in-house. This vertical integration allows them to ship a full rack that is plug-and-play ready for liquid cooling, something that requires multiple vendors to achieve if you go with a competitor. The financial health of the company, despite the filing delays, remains a paradox. Revenue growth has been explosive, driven by the insatiable demand for NVIDIA H100 and Blackwell chips. However, margins have been under pressure. This margin compression is what spooked the Schwab Intelligent Portfolios algorithms earlier this year. The company was aggressively pricing their servers to capture market share, sacrificing short-term profit for long-term dominance. This strategy is risky. It burns cash and lowers earnings per share, which makes the PE ratio look worse, but if you understand the land grab phase of a technology cycle, you know this is exactly what Amazon did with cloud computing and what Tesla did with EVs. You sacrifice margin today to lock in the customer for the next decade. It is vital to discuss the relationship with NVIDIA. NVIDIA stock is the sun in the solar system, and SMCI is the planet closest to it. When NVIDIA sneezes, SMCI catches a cold. But there is a decoupling starting to happen. NVIDIA is becoming a chip designer, but they need someone to actually build the massive, heavy, complex racks that house those chips. That physical dependency is growing. Recently, there were rumors that NVIDIA was diversifying its supply chain away from SMCI due to the auditor issues. While plausible, the sheer volume of orders suggests that NVIDIA cannot afford to cut off its biggest partner. The backlog is too deep. If NVIDIA wants to hit its own revenue targets, it needs Supermicro's manufacturing capacity in San Jose and Taiwan. Traders who use the Fidelity trading platform have likely seen the high implied volatility on SMCI options. This indicates that the market is expecting a massive move, either a breakout above $50 or a breakdown below $20. There is very little middle ground priced in. This binary outcome is tied to the upcoming deadlines for their compliance plan. If they file their missing 10K and Q2 reports and get a clean bill of health from BDO, the short squeeze could be violent. The short interest in SMCI has remained elevated, and many of those shorts are trapped from lower levels, paying high borrow fees. A single piece of good news regarding the filings could trigger a rush to the exits for the bears. Now, I want you to take a moment and think about your own position. Comment below with how many shares of Supermicro you currently hold, or if you are waiting for the filing situation to clear up before entering. Are you playing the volatility, or are you investing for the long-term AI infrastructure play? It is always fascinating to